It seems like this credit card thing is not going to happen at this point. It also seems like if it did happen, it could be good for Klarna. So given that it's probably not happening, kind of how are you thinking about it at this point? And it seems like it's been kind of a good marketing point for you guys this week.
Well, maybe I'm the only CEO of a bank that actually dares to talk about this topic because, we are one or maybe the only bank in the world who hasn't built our whole profit on the idea of putting people in making them revolve up to $5,000. Our average balance is $100 and not having them pay, 30% on revolving. That in the US in total generates $30 billion of revenue per year. So obviously this, in my opinion, very thoughtful and good suggestion from Trump to cut it to 10% would have returned maybe 20 billion of that back to US consumers. And it's not uncommon. We've seen interest rate regulation in Europe work pretty well.
There is one of your competitors, sort of a fintech startup called Gilt, that's now said they're going to come out with a credit card that has a 10% cap on interest rates. Would you guys be willing to do the same?
Ours are 0% if you look at the buy now, pay later product. And I think in general,
I'm saying a credit card specifically.
No, we have a credit card as well that offers you to put on installments, single transactions at 0%. So you could do that. But I think, again, it comes back to, so the answer is yes.
The answer is yes. You guys would come out with a credit card at 10%.
Well, we would definitely consider it. I think, again, the question is how do you construct a product that is healthier than the existing credit products? And one is to avoid revolving, and another one is to not try to make money by pushing people into debt and maximizing on the interest rate. So you have to find other ways of making money, or you just accept a slightly lower return on investment, which is what Klarna has done. In one way you could call us a more affordable bank, means we accept slightly lower profitability. But what's interesting is when you do that, you get the self-aware avoiders, customers who actually have learned themselves the hard way that credit cards do pushes them into debt and are looking for alternatives. And those are very economically savvy and interested customers. And hence our losses are 30 bips lower than industry standards, with about 30% lower than industry standards. So because that audience is also more careful about their spending habits and you don't make them max out. If you do make people max out, you're going to see higher losses.
By the same token, I've seen study numbers that say that using buy now, pay later does encourage people to spend more than they otherwise would, either buying more stuff or spending more on particular items. I guess what I'm saying is, what did they say about glass houses? There's criticism of buy now, pay later and how it potentially promotes irresponsible spending as well. So how would you respond to that?
Well, first, it's very important to know that the most money you can make in the world from marketing is to sell credit card ads and financial services ads, because these guys are willing to pay a lot. And so we have a very strange society where a lot of people are making a lot of money from promoting cards. And that in itself then may lead them to write more positively about credit cards as a product. There's also a lot of lobbying going on because there are tremendous profits at risk here. But the truth is that, and as I always say, look, I'm still offering people a form of credit. Credit can always and will always have the downside of occasionally leading people to overextending themselves and so forth. But what you have to ask yourself, is it a better form of credit than the traditional form of credit? And I would argue, everything else equal, if you either have a person using a credit card, putting all of their spending every month on that credit card and then revolving, leading to about $5,000 in average balance and 30% interest on that, as compared to using primarily debit, then occasionally using buy now, pay later with a fixed installment and a 0% interest, that is, with an average outstanding balance with us, which is about $100, that is a better outcome for society and for consumers at large. But I'm still fighting fire with fire, which is pretty effective. So I'm not selling debit cards only, right? We do offer debit cards as well, but we are offering credit. So obviously, there's always going to be issues with credit. And what we have to do is make sure that we offer this responsibly, following all the regulatory requirements, but also being thoughtful about how we promote and suggest the usage of our products to the consumers.
Sebastian, I'm curious about something. There's been a lot of fintech innovation over the past decade. You guys are part of that. You got blockchain, you got all stable coins, all kinds of stuff happening. Fast forward 5-10 years from now, what do you think the financial landscape looks like? How do most people bank? How do most people pay, do you think?
Well, yeah. I mean, we thought about that in 2015 when we pivoted in this direction. We sat down, we asked ourselves, where is the future going? And our conclusion was the future of financial services is going to be a digital financial assistant that looks at your spending, look at your day-to-day transactions, but also your mortgages and your insurances and all that. And basically, over analyzing it overnight, wakes you up in the morning and say, hey, I looked at your mortgage, you're overspending, I could save you $20, and I've done all the paperwork and negotiated a new one for you, so the only thing you need to do is say yes. At that point of time, will you care that mortgage was with Wells Fargo or somebody else? You won't. You'll be like, thank you, assistant, thank you for $20, I'm happy to take it. Can you fix my home insurance as well? So we concluded that that's the direction in which financial services is going. Now, this is like self-driving cars. I can't tell you when it will happen. I can only tell you that I'm very certain it will happen. And what it means that the excess profits that we have seen among retail banks are gonna go away. Because the excess profits that exist in retail banking today come from the fact that switching cost is high, come from the fact that we as consumers find these products complex, boring, don't put enough energy on researching and comparing alternatives, and it's hard to do so. With the help of AI, we will be supported in doing that, and that will drive down excess profits, and with the help of AI, it will be easier to switch bank accounts.
Sebastian,
you will ask your AI assistant to switch it for you. So it is the end of excess profits in banking that we're seeing, and fintech will contribute to that.
I mean, looking at the bank earnings we've gotten so far this week, it looks like we're still pretty far, though, from, I did say 5 to 10 years, to be fair. But those profits are still alive and well.
That's very true. And that's, it's always like, it's always a question of, again, to your point, some people believe this is going to happen earlier. Some people would say it's going to take a longer time. I've been doing this for 20 years. To me, it's very clear that whoever dares to be the bank, just like Walmart was, just like IKEA was, these large companies that recognize that when they became bigger, when they reached scale, they took some of that profit and lowered their price and make themselves more affordable. Whoever is willing to be that driving force in banking is the long-term winner. And that's what we're trying to be with Klarna. And over time, you'll have to sacrifice a little bit of profit, short-term profit for that, but you're going to build trust and the benefit of an audience that actually sees that you're, and then I don't know when did you last time hear one of those banks now as they report these amazing profits say, and as a consequence of this amazing quarter, we're giving this back in lower interest rates to our customers. Like I don't hear them say that. It's not happening.
You don't hear too many public companies generally saying that, not just in banking, but
True.
So, John, it has been an interesting few weeks of this new year, to say the least. But let's sort of zero in on earnings and what we've been hearing so far from the bank stocks. What is this telling you about how earnings are going to go and whether that's going to continue to sort of propel stocks higher?
Well, Julie, it's still too early really to judge the direction of the whole earnings season with really things just getting underway with the big banks. But we've got to say, with just about 5% of the companies, a little over 5% of the companies having reported thus far, I mean, my gosh, this looks like we're going to have a good earnings season, and a lot of surprises that are positive surprises. I think it's 82% are positive surprises. And we think the guidance is good. Some of the selling we've saw on good news, pretty typical of late. The traders seem to sell things. They sell less harshly on good news and positive surprises. And of course, they'll trounce something that disappoints. Even if guidance for the forward is better, they're show me. It's we're from Missouri kind of attitude.
Yes, definitely. John, as somebody who is pretty darn bullish for this year, I believe you have one of the highest, if not the highest, targets for the street. I'm curious how you're thinking about this year differently from last year, or if you are. Like, is the same playbook going to work this year?
It's a similar playbook, but it's a broadening playbook, and we've seen the broadening really goes back to the fourth quarter of 2020, when it had been a bear market kind of year, and the market got trounced on a lot of negative pitch book stuff that was never realized. Earnings recessions and unemployment and recession, all that didn't happen. But the bounce showed an interest in things beyond tech, but with tech in the leadership. But it's become much more pronounced now. I mean, if you just look at what the market has done so far this year, I'm looking. Materials are the best performing sector year to date, up over 7%. Industrials nearly 7% up. Energy up 6.5%, and staples up 5.7 or 5.3. No, 5.7. Looks like I need reading glasses. But anyway, what we're seeing is a rotation, and it's not necessarily away from technology, as we would think. It's some profit taking to broaden one's exposure and diversification. And then the smalls and mids are doing great. They are essentially outperforming stateside with gains. Mid caps up 6.4%. The S&P 600, a better quality small cap, up 7.3, and the Russell 2000, when the tide comes in and all ships float, up 7.76%.
I mean, it's been pretty remarkable to see that Russell 2000 make new highs and to see some of that other rotation that you're talking about. But John, man, we've been talking about broadening for a long time. This is something I've been talking to you about. I've been talking to other investors about for a while. And we've seen these sort of little feints at doing this broadening that then have faded. And so I guess the question is this a more sustainable broadening than what we've been seeing over the past year?
We believe it is. We believe that at this particular stage, we're beginning to see, if you just consider, what was it, the most recent GDP number, I think the third quarter came in at 4.3 versus 3.8 or something like that expected. It's the economy is showing resilience and strength, but not robust. We don't want to see robust. We like resilient. Great operative word. And then in terms of corporate earnings, managements are doing well. In terms of the consumer, soft data, of course, can tend towards the negative, but the hard data shows the consumer keeps shopping, even though perhaps they've toned down the volume of spending. But at the same time, they still shop, because in the U.S., we judge our jobs and our dedication to things on what we can buy, indeed, for ourselves and for our loved ones.
John, do you think that if the broadening is going to stick around, are you participating in some of the buying in some of these groups that you were just talking about, materials, industrials, even energy?
Right now, we hold positions in all 11 sectors. Our overweights tend to be infotech, communication services, consumer discretionary, industrials, and financials. But we also hold positions that are slightly overweight where the market is in energy stocks, as well as we have positions market weight related to utilities, as I recall.
And if I, as a bullish guy, as an optimistic guy, I think probably by nature as well as by profession, John, if I was to pin you down and say, listen, what could go wrong this year? What do you think has the highest likelihood of going wrong this year? What would you say?
Well, first thing I would say is anything can always go wrong. It's always the unexpected that bites, right? But we'd have to think here that on expectations, it could be just earnings disappointments, all of a sudden a realization that technology's morphing process has reached a plateau, like it did during the tech bubble. Or it could be short term, very short term would be some kind of geopolitical rattle thing that would cause the market to wobble. But generally speaking, geopolitical risk turns into opportunity to buy shares, because uncertainty tends to be profitable these days.
Yes, it does. And speaking of uncertainty, I mean, this year there's already been a lot of headline risk coming from Washington after a little bit of a lull. Do you, as an investor, just try to ignore that entirely? How do you handle it?
Well, one thing is we've noticed, as you know, I've been in this business. This year is going to be 43 years sometime between May and July. I've seen just about all boom, bust, and recovery cycles. In this particular cycle, the market tends to discount both good news and bad news very quickly. So we take comfort in that, but we would have to say the president's saying that he was going to try to cap at 10% credit cards, and now it looks not so much that he's backing away, but he's refining his thoughts on that, seem to assuage the market somewhat. Let's see how financials do today. And then the other thing would be we would consider, concerns related to the hyperscalers and just worries about when will all this investment of theirs become profitable. And we think the real answer to that is anytime you invest in watershed change in technology, first you invest and you got to wait a while to make profits. So investors should really think patience may be what's required here. So we think there's a lot of offsets to the negative potentials.
Netflix is upping the ante. According to the Wall Street Journal, the streaming giant is pivoting to an all-cash offer for Warner Brothers Discovery Studios and streaming assets. It's another power play meant to clear the air as Paramount Skydance's hostile bid for WBD continues to cast a shadow over the deal. Joining me now with his take on the potential outcome of all of this is Rich Greenfield, partner in media and technology analyst at Lightshed Partners. Obviously, this saga has been ongoing. Rich, thanks for being with us. So what do you think?
I'm getting tired of talking about it, Julie.
Join the club, So I'm just curious, what do you think the ultimate outcome is going to be? Who's going to win this thing, and what's going to be the final thing that sort of makes it end?
Well, look, I think the moving to an all-cash bid, which hasn't happened yet, but wouldn't surprise me. Netflix reports Tuesday after the close. It wouldn't be surprising that sort of ahead of or tied to earnings if they make this adjustment. They're not doing it. I don't really believe they're doing it because their stock is modestly below the collar, which would mean that the overall bid is 30, 40 cents light from what they said originally. I think this is about timing. Paramount has talked about the fact that they think they can get regulatory approval far faster than Netflix. Now, whether that's true or not, when you think about states and foreign markets, there is still a lot that we don't know in terms of the regulatory review process. But in moving to all cash allows for a shareholder vote that could be in March versus a shareholder vote that would have probably have been in June. And so no one's going to have regulatory approval on this. It's not even possible to have March regulatory approval. So you sort of move that at least perceived by Paramount advantage, you take that off the table, and you basically put pressure on Paramount. If they're going to raise their bid, they've got to raise their bid sooner than later.
Okay, so if it does go to cash and it goes to a shareholder vote in March, Paramount has said they're going to take their bid to a shareholder vote also. If you were a shareholder, what's the most appealing outcome here?
I think the problem is right now with Paramount, again, assuming an all-cash bid, I think Paramount is in a tough place because with their bid where it is, the value of Discovery Global, I know Paramount has continued to say it's worthless. And remember, they need the split not to happen, because if the split happens, all of the cash flow that they need to finance this transaction disappears too. So mission critical for Paramount is to stop the split of Warner Brothers and Discovery Global. Discovery Global is spinning off. The board looks at that as a critical transaction because they want to get these cable networks off their books. They want to start chopping them up, selling CNN to someone, selling Food Network and HGTV. They basically want to run an auction for the entire portfolio of assets. That's only possible if you get this split accomplished. And so I think unless Paramount meaningfully raises its bid, I don't think a couple of dollars does it, they have to meaningfully $4, $5, maybe even $6 raise the bid. And that's going to require a heck of a lot more cash that right now they don't appear to have, because I think if they had more cash, they would have already raised their bid.
So you came out with your predictions at the beginning of the year, and you said you thought the spin was going to happen. Netflix is ultimately going to win, but it won't close this year. They won't get regulatory approval. Has anything happened to change that view?
No, I mean, look, I think that is what we believe. And look, there's always the outside possibility. Larry Ellison is one of the world's richest people. Instead of putting $12 billion into this, could he put 40, 50, 60 billion of cash, dramatically delever Paramount, enable them to raise the bid, equitize the current bid? Sure, there is certainly that potential. There have been no signs throughout this entire process, if anything, going to get Middle East money, leveraging Paramount to 7 times at closing. There are certainly no signs yet that the Ellison family is willing to put far, far more capital in. And so that's why we still struggle to believe that Paramount wins. I know it feels like consensus on Wall Street that Paramount's going to come out with a knockout bid. It just hasn't happened, and it feels hard to see it happening right now.
Okay, Rich. Well, we're sick of talking about the ins and outs of the bid and what does each bid look like and are they going to raise it. There is something new this morning that maybe we're a little more excited to talk about, and that's Ted Sarandos's come to Jesus moment on theatrical release, apparently. He gave an interview to the New York Times, and in it he said, when this deal closes, we'll own a theatrical distribution engine that is phenomenal and produces billions of dollars of theatrical revenue. He says that he's committing to keeping the 45-day window between theatrical and streaming release. And he says, we want to win. I want to win box office. And he sort of insists in the interview that this is not a change of heart for him and for Netflix.
I mean, look, to be fair, Netflix was never going to do advertising until they did advertising. Right. So, there's certainly business models change over time. I think when Ted says he wants to win box office, I think he'd love to win weekend box office. Whether he is really in it to win global full year box office, I think is a very different question. And my guess is there's some very careful use of words when he's describing win the box office. Like if he's putting a movie in theaters, I'm sure he wants Narnia to do amazing on IMAX screens when it comes out this December. Whether he wants to be the box office champ ever, I think is an entirely different story. But look, I think the reality is Hollywood is very worried. I mean, they're actually worried about both transactions because you've got, if Warner Brothers and Paramount merged, that's 2 studios, just like Fox and Disney merged. And while they talked about keeping both studios, look just years later, that's obviously been collapsed. And so Hollywood is scared of change. I think they're worried about Netflix because of what happens to theatrical, and in terms of their commitment to theatrical. They're worried about Paramount because it is 2 studios into one. And I think Ted is trying to give assurances that they're not anti-theater. I mean, they've released a lot of movies in theaters. They've even put Stranger Things in theaters, on New Year's Eve. So I think they see theatrical as a way to create events. Whether it's 45 days, I find it hard to believe that any part of Hollywood is going to be able to stick to 45-day windows, given what's happening in box office. I mean, the thing that no one's talking about, Julie, box office is down 50%. Sorry, attendance, not box office. Attendance, meaning butts in seats, are down 50% from before the pandemic. And so the theatrical experience is just becoming less and less appealing to Americans. This is not a Netflix thing. This is just fundamental human behavior.
It's interesting because it's been lagging a little bit, right? And some of the valuations have come down to some extent. So I'm curious, as we get into earnings season, whether you think that the numbers are going to reconfirm some of the optimism, or that it doesn't matter because of how they're priced.
Some of the numbers will confirm the optimism, but it doesn't matter because they're expensive. So I look at this market as one that people think that fiscal and monetary stimulus stimulates the economy. No, it doesn't. It doesn't stimulate the economy. It stimulates asset bubbles. And as long as we are content to recklessly overspend, it will fuel surges in profits, and it will fuel surges in valuation multiples. So I don't see anything that would cause that to come to a grinding halt, but I would rather use the strength of the market to fade my existing exposure gradually and to redeploy money into markets that are cheap. Non-US stock markets, even after a winning year last year, are still very cheap relative to the US, and value is very cheap relative to growth. So to the extent people want to take some of the chips off the table on the growth side and redeploy them into markets that are cheap, I think that will pay off handily in the coming years.
It's really interesting that you say that about stimulus because Kathy Wood of ARK Invest, well-known growth investor on the other side, she just came out with a letter to investors recently, and she said the economy is a coiled spring. That's what she called it. And she talked about some of the stimulus that should make its way, whether it's taxes or some of the other stimulus measures. What do you think of that view? I mean, that because we are going to see some benefits accrue, for example, from the tax bill.
Refunds are going to be huge. I actually suggested to the administration that they have an executive order and direct the IRS to issue 2 refund checks. One for what it would have been before the tax bill was passed, and the other for the difference from the tax bill.
That would be politically interesting.
It would be politically very interesting. But in point of fact, yeah, that's a one-off stimulus that's going to be huge. How does stimulus work? It puts money in people's pockets, particularly in the pockets of people with high propensity to consume. The middle class, the lower middle class, the working poor, they have high propensity to consume. They'll spend the money in the private sector, and that will bolster earnings. Bolstering earnings flows largely to management and shareholders. Management and shareholders have low propensity to consume. So they run out and put their money in VU or our new Rouse ETF, and in so doing, push up valuation multiples. And so you have a surge in earnings and a surge in valuation multiples strictly on the back of stimulus.
And what's wrong with that?
There's nothing wrong with that.
Okay.
It does increase wealth inequality and income inequality. And so it achieves the opposite of its intended effect, but it does bolster wealth, and that's not a bad thing. It lays a foundation for when this $38 trillion in debt causes the markets to lose confidence in U.S. debt service ability. At some point, this has to reverse. But I don't see that as being in any way imminent. I think we're setting the stage for another financial crisis sometime in the next 10 to 15 years, but I don't see it as imminent.
So let's go back then to the here and now. You mentioned that international stocks still look like a good deal to you right now and have some more upside. Where else do you think that investors are not focused enough right now? What are some overlooked things that you think they should be looking at?
Well, one of the things that's just fascinating is we have this strange binary duality where investing is looked at as growth versus value.
Right.
Value is cheap, growth is expensive. Pardon me, expensive doesn't mean growth, expensive means expensive. It's actually a two-dimensional thing. Cheap versus expensive, and growing versus not growing.
Right.
Most stocks that are growing fast are expensive, but not all of them. Most stocks that are cheap aren't growing very well, but not all of them. And we need to throw that stupid binary worldview out the window.
Well, so let's take a stock like NVIDIA, which is much more reasonably valued than it was, so on a relative valuation basis. And it's certainly growing.
Oh, yeah.
So like, what do we call that? Is that a growth stock?
Oh, my goodness, yes. We created RAFI Growth back last July. And I wish the idea had occurred to me 20 years ago. It didn't. But instead of calling expensive growth, let's call growth. If you identify companies that are growing rapidly, that is to say 5-year growth in sales, 5-year growth in profits, 5-year growth in R&D spending is high, those are growth stocks. Take the top 25% of the market, call that your growth portfolio. How do you want to weight it? By market cap, where you put most of your money in the most expensive stocks? No, how about doing it weighting the stocks in the portfolio by the dollar magnitude of their growth? If you do that, the 2 biggest stocks in your growth portfolio will be Apple and NVIDIA, because their dollar magnitude of growth is stupendous. In fact, each of those stocks individually explains 10% of all sales and earnings growth over the last 5 years. The nation's sales and earnings growth, 10% comes from Apple, 10% comes from NVIDIA. So those are your two biggest holdings. There's two stocks in the Magnificent Seven that don't make the cut and aren't in our index.
No. Tesla? No.
No?
Tell me which ones.
It's Amazon and Microsoft.
Huh.
Their growth in the 2010s was stupendous. Their growth in the 2020s has been nice.
What's the cutoff between stupendous and nice?
Top 25%.
Okay.
So they're in the second 25%.
So it's on a relative basis.
Right.
Gotcha.
So their percentage growth rates are nice. They're faster than the economy, but they're not the blistering pace of the 2010s. Apple is impressive growth off of a huge base. NVIDIA is stupendous growth off of a low base. The dollar magnitude of their growth is very similar. One because it was huge and grew quite a bit, and one because it was tiny and grew phenomenally. But if you do that, if you create an index where you choose stocks by the percentage growth rate, weight them by the dollar magnitude of the growth, going back over the last 28 years, we find that would have beat Russell 1000 growth by 4.7% per year compounded for 28 years. So this is one of the exciting new product ideas that we've launched that it's not yet investable.
Right.
But it makes up one leg of what we call a trifecta. Best value strategy, best growth strategy, and best core strategy available.
Dave, as you've been covering the earnings this week, you've kind of come to several different takeaways. So let's run through what your takeaways were.
Right. So I think one is just, you heard it on the, we were talking about it on the show for weeks. It's just that all six of the big Wall Street banks have seen strong stock rallies. And so there's a lot of expectation for good and a little bit more room for disappointment given that they're historically at high valuations. So that was sort of the backdrop going into this. Then actual earnings results for the fourth quarter were a little bit noisy on a couple fronts. Citigroup had a one-time charge, so did JP Morgan. And then we had
Goldman Sachs with the Apple Card
Exactly,
situation.
yeah. And so expectations were a little bit mixed as a result. There's also some less appealing deal-making results. But because of all of that, analyst expectations in a way were not really, not necessarily grounded to what had been reported was going to happen. So there's some confusion each day of earnings in terms of the stock reactions immediately afterwards. But if you look at the full year outlook in terms of what the big banks have achieved in 2025, it looks pretty good. But then on the other side of that, a lot of the conversations during the earnings calls between from media and analysts had a lot to do with these things that are totally new and kind of clouding the outlooks for these banks in 2026, like the credit card cap demand from President Trump that came over the weekend. And then on top of that, I think in general, just the idea that the policy outlook is a little bit less clear.
Yes, right, and all of the noise around the Federal Reserve and Chair Powell as well. Ken, let's bring you into this. You heard Dave kind of sum things up here, that things look pretty good at the banks, but they're also they've also had a pretty good run. So how are you thinking about it?
Yeah, well, it's great to be here. And for 2026, we're looking for an outstanding year. Going into the fourth quarter, it's essentially trying to position yourselves that you can underpromise and overdeliver for 2026. The 25 results in itself, unless there was something significant, is really not going to change the trend as it relates to performance, revenues, and earnings. The controllables seem very good for the banks. And as David mentions, the uncontrollables or risk are noisy, but not necessarily changing the fundamentals for 26. So what we see is obviously the capital markets, both trading and investment banking, look to be very strong. The book is opening for equity underwriting. That was a disappointment on year-over-year comparisons in the fourth quarter, but I think it's the calendar just rolling into Q1, and that's actually good for the banks and bank stocks. Second, when we look at elevated equity markets, not just the US, but the world, that really bodes well for fee income on asset management, institutional, and wealth management. And then there's the transaction services that they have. Of course, the Morgan Stanleys and Goldmans shine better than JP Morgan or Bank of America, but we have it overweighting for the whole sector. It's 14% of the market. These 6 large banks are more than half of the top 10 top 10 constituents of the sector. It's about 60% of the sector. So you got to make a call on the global banks. We do, and we are positive.
Ken, when you look at all of the, the controllables versus the uncontrollables, leaving aside DC and policy for a moment, there are still a lot of uncontrollables. IPOs could still be weaker this year than some of these high expectations are baking in. We don't 100% know where rates are going, for example. We don't know where the economy is going and what the lending environment is going to be. So of kind of those things that are less known, which, are you sort of rating them on high risk, low risk, those various variables?
So baseline for the traditional commercial banking, we actually saw a pickup in commercial loans. So I think loan growth is expected to be maybe mid-single digit. That's healthy with the economy growing 2 to 3%. To your question about IPOs, so I cover the top 8 private equity firms. They're sitting on $2 trillion of companies owned that have to be monetized over the next few years. That process began really summer of last year. It's going to pick up this year. The reason for this is you can only do so many different levels of financing on the private side to grow businesses, and they're realizing that there's a bigger opportunity with the public equity market today. That was not the story of the last 3 years, and retail, not only institution, is now becoming an increasing big part of the equity market. That's all good for equity underwriting, and it's a global phenomenon. Actually, Hong Kong was one of the largest IPO markets coming off China new companies, and of course the US is going to do great. So I think there's a lot there really as a delta to surprise on the upside. Q4 was a disappointment, but it's to my point of a timing difference on the book and the calendar.
And Dave, it's funny the other item you referred to, the sort of headline risk from DC about the credit card talk. These companies kind of push back against it on their calls, and it doesn't seem like that is going to happen. But maybe it distracted from, Ken was just talking about private equity. Were there a lot of private credit questions on the calls, or did they sort of avoid those because everybody was talking about credit cards?
Yeah, that's actually true. I know there were a couple that came up, but none of it really materially changed things. One thing I will point out is that the lending revenues at these banks are really picking up in relationship to their markets divisions, their trading divisions. So the amount of lending they're seeing the most pickup in is to these non-bank financial companies like the private credit firms. And JP Morgan actually broke out how much they lend to private credit funds. So that's becoming an increasingly important part of their revenue stream. And then it's also kind of a place to watch for risk in terms of what that means to their exposure to private credit.
Yeah, Ken, what do investors need to watch there to see if there are any warning signs, if not industry-wide, even on a bank-by-bank basis?
Yeah, we don't see anything systemic. We're watching, again, the largest players. It's likely it's going to be idiosyncratic to some one-offs related to some problem small loans. But the private equity firms with their private credit businesses do a heck of a lot more due diligence than the large banks. So I'm fine there. On Washington, noise, but the subtleties with the Fed, of course, we've all seen with rate cuts, Chairman Powell, whether Trump gets 1 or 2 appointments. But on the supervisory side is a positive story, potentially easing the regulatory framework, whether it relates to the new stress tests for 2026 or the ability where banks can do a capital release, not have to increase reserves because of high distress scenarios. Very different than Switzerland, what UBS is facing. But in the US, what that means for investors is, in addition to price appreciation for these stocks, opportunities for dividend increase and share repurchase.
Ken, when you get those little headlines, though, like the credit card situation or like the threats to the Fed, is that sort of a reminder to financial investors, maybe don't get too comfortable and optimistic about the outlook on deregulation?
The bear case, of course, is if you've been covering this industry, which I have, for over 15 years, and many analysts have, you're reminded of when you have distress periods. We don't think that's the situation today. We also track all banks on credit risk. It's fine. The bull case is risk to the upside to what I said at the beginning of this interview, which is where the banks have underpromised. I think they'll over-deliver. Q1 is usually one of the strongest quarters, particularly in the capital markets. So we'll just have to see how this plays out. But all this is really important because we have to, analysts, justify the higher valuation or multiples for these banks. And that can only be achieved if we see upward earnings revisions from the consensus. I think that's going to happen unless there's any change in the economy or any kind of black swan event, but that might be a buying opportunity if they sell off.
Ford CEO Jim Farley has warned repeatedly of a blue-collar employment crisis as the company struggles to fill mechanic positions. Ford's partnership with workwear brand Carhartt and nonprofit Toolbank USA is aiming to help bring more workers into the trades. As of November, there were just under 400,000 job openings in the manufacturing sector. Let's bring in Linda Hubbard, CEO of Carhartt, as well as Yahoo Finance executive editor Brian Sozzi. Linda, thank you so much for being here. So how exactly is this going to work? And why are you guys convinced that giving away free gear generally is good for recruiting? But talk to me about how this is going to work.
Well, we're so excited about this partnership with Ford because I think our two companies joining forces really allows us to scale some of these initiatives that we individually have been talking about over the last several years. This idea that jobs in the skilled trades, technical workers, are really undervalued jobs in our country right now and difficult to access. And so as we spoke with Jim Farley and Ford, we attended the Accelerate conference that he hosted last fall. We really, realized that collectively we have the same goals and that together we can be even stronger. And as we last year, our own campaign at Carhartt was around Made Possible. And what we were trying to highlight was all of the opportunities, all of these amazing jobs that people are doing out there that are really unnoticed or maybe people take for granted, but are incredible careers and opportunities for young people to make a great living for themselves and their family. So this connection with Ford has really will help us to really identify some tactics to go along with that awareness.
Linda, it's Brian here. Good to see you. I think I just missed you at that Accelerate event. That was the last time I saw Jim. And when I talked to Jim, he struck me by a lot of numbers he put out about the shortages for essential workers. One of them was, he's like, Brian, I have 6,000 bays open right now. We need mechanics to work on our cars. The fact that we can't get people into these jobs, how has that impacted a business like Carhartt that sells gear for them?
Well, we want to continue to, part of our mission, of course, is to make great gear to serve and protect the people that are doing these really difficult jobs. But we also, part of our mission is to continue to help them in different ways. And some of that is to just show there's opportunity out there for new people interested in the trades. And yes, of course, we'd love when they join the trades for them to be wearing Carhartt. Our partnership with Ford specifically around their auto training program is we're going to outfit the graduates, their scholars, their Auto Force scholars in Carhartt gear when they graduate, so they feel a sense of pride and confidence as they begin their new careers. So yes, of course, there's an obvious connection between our brand and the Ford brand and these people doing the hardest jobs around the world in every corner of the world. But even more importantly, I think all of us at Carhartt and Ford feel ourselves kind of called to this higher purpose of improving the economy, improving the lives of young people that are looking to make a better living for themselves.
Linda, of course, in addition to outfitting people in the trades, you employ people who make stuff, right? Clothing, namely. And
Yes.
I'm curious if you're having trouble filling positions in North America for folks who are making the apparel in your factories.
Our factories are in some small towns, and so, because of that, we have some, good source of labor very close to where our sewing factories are. We also, of course, are making product globally all around the world. So I can't really speak to all of our suppliers and how they're finding people to build our product. But we feel great about the people that we do have here in the U.S. in our own sewing factories. Some of them have been with us a long time, and we continue to attract new, younger associates as well.
Linda, what's the secret behind the Carhartt brand crossing over to more mainstream? Why do you think that's happened?
First of all, we're thrilled to have everybody interested in the Carhartt brand, but we really, truly are a workwear brand. Everything that we make is work worthy and is really meant to be worn to protect people from the rigors of the job or help them do their job more effectively. I do think that people are intrigued by functional workwear, and it does add to the value of buying a piece of clothing if it's going to last a long time or serve you for multi-purposes. So I think people are attracted to the authenticity of our brand and what we stand for, and we certainly welcome anyone in that wants to celebrate hard work and be connected to Carhartt and the people that are doing those difficult jobs.
Linda, Carhartt is really, it's a unique company, family owned, in business 137 years, outfitted the Ford factory workers in the 1920s, but also unique in the sense you make product in the United States. Sure, you do business around the world, but you make product in the U.S. How can you do this profitably given the costs of labor and other components?
We have been a manufacturer, obviously, for a long time. The people that make our product are really in the U.S. and around the world. It really is a craft. There's a very long training curve to be able to, sew and to do this work. But we've been very careful to make sure that we continue to make our product and the prices that we charge for it accessible, because we know our worker is challenged with how much discretionary income they have. So we have continued to be, effectively manage our cost and be able to provide great value and durability to our consumers.
Linda, thanks so much. Thanks you as well, Brian. Appreciate it. Netflix is upping the ante. According to the Wall Street Journal, the streaming giant is pivoting to an all-cash offer for Warner Brothers Discovery Studios and streaming assets. It's another power play meant to clear the air as Paramount Skydance's hostile bid for WBD continues to cast a shadow over the deal. Joining me now with his take on the potential outcome of all of this is Rich Greenfield, partner in media and technology analyst at Lightshed Partners. Obviously, this saga has been ongoing. Rich, thanks for being with us. So what do you think?
I'm getting tired of talking about it, Julie.
Join the club, So I'm just curious, what do you think the ultimate outcome is going to be? Who's going to win this thing, and what's going to be the final thing that sort of makes it end?
Well, look, I think the moving to an all-cash bid, which hasn't happened yet, but wouldn't surprise me. Netflix reports Tuesday after the close. It wouldn't be surprising that sort of ahead of or tied to earnings if they make this adjustment. They're not doing it. I don't really believe they're doing it because their stock is modestly below the collar, which would mean that the overall bid is 30, 40 cents light from what they said originally. I think this is about timing. Paramount has talked about the fact that they think they can get regulatory approval far faster than Netflix. Now, whether that's true or not, when you think about states and foreign markets, like there is still a lot that we don't know in terms of the regulatory review process. But in moving to all cash allows for a shareholder vote that could be in March versus a shareholder vote that would have probably have been in June. And so no one's going to have regulatory approval on this. It's not even possible to have March regulatory approval. So you sort of move that that at least perceived by Paramount advantage, you take that off the table, and you basically put pressure on Paramount. If they're going to raise their bid, they've got to raise their bid sooner than later.
Okay, so if it does go to cash and it goes to a shareholder vote in March, Paramount has said they're going to take their bid to a shareholder vote also. If you were a shareholder, I mean, what's the most appealing outcome here?
I think the problem is right now with Paramount, again, assuming an all-cash bid, I think Paramount is in a tough place because with their bid where it is, the value of Discovery Global, I know Paramount has continued to say it's worthless. And remember, they need the split not to happen, because if the split happens, all of the cash flow that they need to finance this transaction disappears too. So mission critical for Paramount is to stop the split of Warner Brothers and Discovery Global. Discovery Global is spinning off. The board looks at that as a critical transaction because they want to get these cable networks off their books. They want to start chopping them up, selling CNN to someone, selling Food Network and HGTV. Like, they basically want to run an auction for the entire portfolio of assets. That's only possible if you get this split accomplished. And so I think unless Paramount meaningfully raises its bid, I don't think a couple of dollars does it, they have to meaningfully $4, $5, maybe even $6 raise the bid. And that's going to require a heck of a lot more cash that right now they don't appear to have, because I think if they had more cash, they would have already raised their bid.
So you came out with your predictions at the beginning of the year, and you said you thought the spin was going to happen. Netflix is ultimately going to win, but it won't close this year. They won't get regulatory approval. Has anything happened to change that view?
No, I mean, look, I think that is what we believe. And look, there's always the outside possibility. Larry Ellison is one of the world's richest people. Instead of putting $12 billion into this, could he put 40, 50, 60 billion of cash, dramatically delever Paramount, enable them to raise the bid, equitize the current bid? Sure, there is certainly that potential. There have been no signs throughout this entire process, if anything, going to get Middle East money, leveraging Paramount to 7 times at closing. There are certainly no signs yet that the Ellison family is willing to put far, far more capital in. And so that's why we still struggle to believe that Paramount wins. I know it feels like consensus on Wall Street that Paramount's going to come out with a knockout bid. It just hasn't happened, and it feels hard to see it happening right now.
Okay, Rich. Well, we're sick of talking about the ins and outs of the bid and what does each bid look like and are they going to raise it. There is something new this morning that maybe we're a little more excited to talk about, and that's Ted Sarandos's come to Jesus moment on theatrical release, apparently. He gave an interview to the New York Times, and in it he said, when this deal closes, we'll own a theatrical distribution engine that is phenomenal and produces billions of dollars of theatrical revenue. He says that he's committing to keeping the 45-day window between theatrical and streaming release. And he says, we want to win. I want to win box office. And he sort of insists in the interview that this is not a change of heart for him and for Netflix.
I mean, look, to be fair, Netflix was never going to do advertising until they did advertising. Right. So, there's certainly business models change over time. I think when Ted says he wants to win box office, I think he'd love to win weekend box office. Whether he is really in it to win global full year box office, I think is a very different question. And my guess is there's some very careful use of words when he's describing win the box office. Like, if he's putting a movie in theaters, I'm sure he wants Narnia to do amazing on IMAX screens when it comes out this December. Whether he wants to be the box office champ ever, I think, is an entirely different story. But look, I think the reality is Hollywood is very worried. I mean, they're actually worried about both transactions because you've got, if Warner Brothers and Paramount merged, that's 2 studios, just like Fox and Disney merged. And while they talked about keeping both studios, look, just years later, that's obviously been collapsed. And so Hollywood is scared of change. I think they're worried about Netflix because of what happens to theatrical, in terms of their commitment to theatrical. They're worried about Paramount because it is two studios into one. And I think Ted is trying to give assurances that they're not anti-theater. I mean, they've released a lot of movies in theaters. They've even put Stranger Things in theaters, on New Year's Eve. So I think they see theatrical as a way to create events. Whether it's 45 days, I find it hard to believe that any part of Hollywood is going to be able to stick to 45-day windows, given what's happening in box office. I mean, the thing that no one's talking about, Julie, box office is down 50%. Sorry, attendance, not box office. Attendance, meaning butts in seats, are down 50% from before the pandemic. And so the theatrical experience is just becoming less and less appealing to Americans. This is not a Netflix thing. This is just fundamental human behavior.
Yeah, me trying to convince my 16-year-old to go and see a movie in a theater, forget about it. He would much rather be on our couch, Rich. So that in theory is good for Netflix, which brings me to Netflix earnings, which are out next week. And I'm curious what you're looking for there and kind of what you think investors need to zero in on.
Look, I think investors are going to be focused really on, is Netflix doing the transaction? Meaning, are they bidding for Warner out of a position of weakness? Like, is engagement stagnating? Are they having trouble driving engagement and driving more subscriber growth and revenue without Warner? And is this sort of a defensive move? Or is Netflix crushing it, meaning they're really seeing an acceleration from a really strong slate of content in Q4? Is the advertising business starting to kick in and starting to accelerate ARPU? And are they doing this from a position of strength? And I think that's going to be really important because the stock is down on the perception that this is sort of a reaction to weakness. So if Netflix comes out on earnings and really does well, I think it's going to, really cause a surge in the stock because it will change people's perspective on how important this asset is to them, meaning, are they doing great without it? And is this just an accelerant to the story that's already doing well?
Really, really good point. I'm going to be really interested to see those numbers. I want to go back to the idea of Hollywood being scared or a lot of changes coming and them trying to grapple with it. And I want to talk to you about the deal that Ben Affleck and Matt Damon struck with Netflix. Speaking of changing and adapting Hollywood. Sure. They made this new movie called The Rip, and under sort of a different kind of model, there are additional financial benefits that can be accrued to the entire cast and crew once they get to certain viewership thresholds on Netflix. It's a Netflix deal. What do you think of this deal? Is this a new paradigm, or is this just like a one-off because these guys have a lot of power and can do it?
Look, I think Netflix really wanted this film. I haven't watched it yet. I actually downloaded it because I wanted to watch it on the plane this evening. Look, Netflix, go back to the original place we started this conversation, Julie. There's a flexibility, right? And I think they're always looking at alternative models. I mean, buying Warner Brothers would obviously put them in a very different business model on all of the movies that are already greenlit and in process. All of those have back-end payouts to talent rather than upfront guarantees. So, look, The Rip, which I think is supposed to be a very good movie this weekend from Artist Equity, which is Ben and Matt's production company, it does have a different economic model. Netflix has not done that on anything else. But look, Netflix also did an IMAX-only release for Narnia, which is coming out later this year. They obviously put K-pop Demon Hunters in theaters for a few days. They did the Stranger Things stunt. Like, there is a just general, test and learn, I think would be this, in many ways, Julie. Like, does this work out better for Netflix? Do they get access to different content they couldn't otherwise get access to? I think it's showing a flexibility of management, meaning that there's no religion that is unchangeable for them if it leads to winning long term.
That makes sense. And the other story I want to ask you about in terms of a changing Hollywood is the one on Matthew McConaughey this week, where it was reported that he has trademarked all right, and other sayings and his face. And this appears to be an attempt to stave off AI using his image. And obviously that's the other big threat that Hollywood is worried about right now. Do you think
threat and opportunity, right? I mean, movies, think about how long it takes to make an animated movie. I mean, 3 to 4 years, you finish a movie. Let's just say you're shooting, you shoot House of Dragon over in Europe, and it's this massive $30 million an episode type budget. and you need to make changes and, restaging it or bringing the cast back, like those things are incredibly expensive. Does AI have the ability to sort of enable you to do things in post-production that you never could do before? And there's lots of guild issues to work out, but I think ultimately this is going to meaning AI is going to make movie production faster and cheaper. And it's going to allow for more content, because if you take the same amount of spending and you can spread it across a wider array of pieces of content, that's going to be great, because every single company, not named Netflix, certainly needs to create a heck of a lot more content to compete in the streaming wars. And so I think AI, as much as it scares Hollywood, it's a huge opportunity over time.